Hey everyone, welcome to your Algo Lab. In our last episode, we explored the 200-day moving average strategy on global equity indices. If you haven't watched it yet, we highly recommend checking it out. Today, we'll delve deeper into some optimization techniques. There are many advanced optimization techniques available. In this episode, we'll introduce one called grid search. As the name suggests, grid search is an exhaustive search technique used to systematically tune the parameters of a strategy. To illustrate, let's suppose we have a strategy with two parameters. We define our evaluation metric, which could be return, risk-adjusted return, or any other metric. In this example, let's suppose that we have the risk-adjusted return, where a higher value is better. We observe that the combination of parameters 3 and 30 yields the best result. Ideally, we aim for a pattern where the optimal combination is located within a zone of stability. This is important because we want our best parameter set to be robust, meaning that small changes in the parameters should still result in good performance. Returning to our long-term moving average strategy, we have already implemented our benchmark buy and hold strategy and the 200-day moving average strategy. Here we focus on their annualized returns, highlighting where the 200-day moving average outperformed the benchmark for clarity. For our long-term moving average strategy, we have only one parameter to consider: the moving average window. Instead of using a grid with multiple rows and columns, we will concentrate on a single row, testing both shorter and longer time frames. In terms of grid search, we'll select a few specific time frames rather than conducting an exhaustive search. For long-term strategies, our objective is to find commonalities between similar assets, rather than pinpointing a specific parameter to maximize individual risk-adjusted returns. We use different backtesting methods for short-term and medium-term strategies, which we will discuss in future episodes. We'll select two parameters, 50 and 100, which are below the 200-day moving average, and two parameters, 300 and 400, which are above it. We'll run the complete program using these parameters and evaluate the results based on absolute return, maximum drawdown, and risk-adjusted return. Let's first examine the returns. We observe that the 50, 100, 300, and 400-day moving averages have lower average returns compared to the 200-day moving average. While no long-term moving average outperforms the benchmark in absolute returns, the higher returns tend to cluster around the 200-day moving average. This pattern indicates stability, suggesting that small adjustments to the parameter are unlikely to significantly alter the results. When considering risk or maximum drawdown, all long-term moving average strategies outperform the benchmark. Once again, the 200-day moving average strategy proves to be the best among the 5. This clustering suggests that we might have a stable parameter. Now we present the risk-adjusted return, calculated as the annualized absolute return divided by the maximum drawdown. Here we observe that the 4 moving average strategies exhibit a better risk-adjusted profile compared to the benchmark. Again, the 200-day moving average strategy stands out as the best among the 5. This clustering indicates that we might have a stable parameter. Let's take a closer look at some of the best performing strategies in terms of risk-adjusted return, starting with the 200-day moving average strategy on the S&P 500. As a typical trend-following strategy, it features a few big winning trades and many small losing ones. Overall, the strategy performed well in avoiding large drawdowns, such as during the dot-com bubble. Although there were some small losing trades, losses were quickly cut. During the global financial crisis, the strategy effectively avoided one of the most extreme bear markets. Now, let's examine some of the worst performing ones, specifically the FTSE MIB with a 50-day moving average. From 2009 to 2022, the strategy actually lost money. A closer look reveals that the 50-day moving average parameter is too close to the actual index, which itself was in a choppy, trendless market. To wrap it up, today we ran a grid search on our long-term moving average strategies across all global equity indices. While the strategy didn't boost absolute returns, it did improve risk-adjusted returns. Plus, we found that the 200-day moving average might be a stable parameter. But our research doesn't stop here. In the next episode, we will backtest the same strategies on other asset classes, including fixed income, commodities, currencies, and cryptos. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Thank you for watching and see you next time.